The financial crisis no one is talking about. Hello everyone, how are you? Greetings from Aaron here again on the channel. If you use this kind of tracker, your goal is probably to collect information about your daily activity as a way to measure your overall health. Similar to a fitness tracker, it may tell you something about the number of steps you've taken, your heart rate, or even your overall stress levels. Economies employ a variety of data points to measure the state of the economy generally. Consequently, when patterns appear in these data points, we attempt to use them to provide insight into potential future developments. It is extremely unusual to be able to accurately predict market movements or economic activity, but several metrics are worth looking at again, and one of those measurements is the money supply in the US. Regarding the money supply, there are a few different classifications. The first is M0, which is just the total amount of cash and coins in circulation. M1 covers circulation, coinage, and cash. Additionally, reviewing accounts. Consider this group to be the money that is easiest to spend because it is the most immediately available. Next is M2, which comprises savings accounts, cash and circulation checking accounts, CDs and money market accounts, which are marginally less liquid. The M1 and M2 money supplies are the ones that get the most attention. Over time, the money supply tends to trend upward since an expanding economy needs more cash and money to complete transactions. As more money is printed, inflation usually happens slowly, but the cost of products and services rises as well, necessitating both searching for better deals and more money. Decreasing supply. Over the last century, the money supply has generally increased without much interruption. However, recently, an interesting development has occurred. We are witnessing a decrease in the money supply. In July 2022, the US M2 money supply reached an all-time high of approximately $21.7 trillion. As of right now, it has declined by more than 4% from this peak. This is the first notable decline in M2 since the Great Depression. It's worth taking a second look and thinking about how this might affect the economy, the stock market, and ultimately our investments. At this point, you might be wondering why it even matters if the money supply is decreasing. Well, it's noteworthy because declines of 2% or greater on a year-over-year basis in the M2 money supply have only happened on 4 other occasions, and in each of those 4 instances, they have coincided with deflationary depressions coupled with double-digit unemployment rates. In other words, a very rough economy. Simply because previous large reductions in the money supply have been accompanied by extremely harsh economic times does not guarantee that's exactly what we're in for. It is worth noting that the past money supply decline that was at this threshold was back during the time of the Great Depression, so nearly 90 years ago. At that time, our central banking system, the Fed, was fairly new to the scene, and they've come a long way and developed a number of tools at their disposal when it comes to fiscal and monetary policy and when to implement these various measures. But you might remember just a few years ago, during the pandemic, with all the stimulus money, our money supply increased sharp, so some are calling this decline more of a reversion to the mean, rather than a concerning decline in money supply. While monetary supply itself is not an indicator that recession is just around the corner, it is worth paying attention to because if monetary supply continues to decline, and if inflation continues to exceed the Fed's long-term benchmark of 2%, the natural consequence would be less working income based on data from Bank of America Global Research. About 2/3 of the S&P 500's max drawdowns happen after the US recession is officially announced. In other words, a sustained decrease in the M2 money supply could be problematic for the now raging stock market. Alternatively, we're not out of the woods quite yet. The other commercial bank credit money metric worth tracking at the moment is commercial bank credit. Similar to the M2 money supply, which pertains to individuals, it makes sense that commercial bank credit would rise over time as businesses take on loans and leases. To be quite honest, I hadn't even given this metric much thought until my friend Ian Hollow, an attorney who practices corporate law just outside of Chicago, brought it to my attention. Since the pandemic, lending practices have changed significantly, which worries me, especially in commercial real estate where many of the assets were traditionally thought to be extremely safe and boring. Investments that a bank made. Property owners, a low-interest loan, often a 5 or 10-year balloon note. A balloon note is a special type of loan where the owner of a property pays only a portion, typically a small portion of a loan, before owing the remainder at some point. Balloon notes worked as long as interest rates remained low, real estate remained in demand, and the monetary supply kept growing. A real estate owner would simply refinance the balloon portion of the note every 5 years without needing to repay the bulk of the loan. And people always needed a place to work and shop, right? Well, since the pandemic, office buildings have emptied, brick and mortar stores have lost ground to online shopping, and suddenly banks have become hesitant to refinance all those loans that are coming due. Commercial real estate sales have slowed down, especially with high interest rates. And I've personally seen banks in my practice that are very reluctant to add any more commercial office or retail properties to their balance sheets. I'm personally concerned about the situation because so many balloon notes on commercial properties still have not come due, but they will in the next few years. And if you can't lease your property, buyers can't get a loan, and you can't refinance, there aren't a lot of options besides defaulting or asking for a government bailout. There are a few times when a line with recession commercial bank credit has pulled back by noticeable amounts. And again, they've all been associated with recessionary times during the dot-com bubble of 2001, during the Great Recession of 2010, and just last year in 2023 following the pandemic. And again, this metric itself does not tell us of impending doom, but it does tell us that banks are getting more strict with their lending practices, not just with individuals, but also with businesses. But granted, it is worth noting that these numbers have improved mildly since the start of 2024. Limiting lending to businesses can cause businesses to halt expansion projects, or it can induce hiring freezes. All of this has knock-on effects on the overall economy, and personally, once more, I'm not attempting to forecast what will happen next. I genuinely think that attempting to forecast what will happen next in the stock market is nearly impossible because there are so many variables involved. But when combined, the M2 money supply and commercial banking credit are two indicators to watch that indicate we are in a cautious state of affairs. Time is your best friend. So the best course of action is to keep investing for the long term. If you just look at the stock market's performance over the last 3 or 4 years, you might assume that volatility is the norm. In some ways, this is because of the market's abrupt decline in response to the pandemic, which was followed by the fastest recovery in market history, a difficult year in 2022, and an amazing year in 2023. The market has felt like a roller coaster, quite literally. Probably the last thing you want to hear right now is that some indicators are indicating a negative direction, or that you should proceed cautiously. But that's just the way the market works. In the long run, the market is up, even though there are periods when it is down. When it comes to investing, my position is to purchase index funds and hold them for the long term. I don't try to time the market or beat it. Instead, I just try to profit from where the market does. Over the long term, the market has performed incredibly well through wars, recessions caused by presidents of both parties, bubbles, and busts. Long-term stocks have outperformed nearly every other asset class available. Long-term, the market has increased. The investor who perseveres wins. Good days outweigh bad. The average bull market has lasted 11 calendar days. There hasn't been a single 20-year period where the stock market has produced a negative return, meaning that if you stayed invested in the broad market for any 20-year period, you would never have lost money. The 27 bear markets over the past 94 years have persisted for an average of only 286 calendar days, or roughly 9.5 months. Fidelity even had a study that showed the investors who had the best returns were those who did not touch their portfolios. Coincidentally, in many instances, it was people who had already been deceased who had the best performing portfolios. That should really help reiterate the idea of just get invested and stay invested. It can really be easy to fall into the temptation to try and time the market if you think you know what's coming down the line. You think, maybe I'll get out of the market before the worst of it strikes, and then once the worst of it is behind me, I'll just get back in. But for that to work, you have to be right twice. You have to be right when you leave the market, and you have to be right when you jump back, and those are both incredibly difficult tasks. So this is simply to serve as a reminder, no matter what you're hearing about the economy or the market, no matter what metric you're looking at, stay the course, keep investing, because long-term the market goes up. What do you think? Which topics would you like to see covered next? Let us know in the comments below. And as always, thanks for watching.